I know you've seen the headlines. Interest rates have been at 7% plus and climbing for a week and running. What happened? They were at like 6% and declining a little bit ago. Well, here's the thing. Let's take a step back and I'm going to provide you some perspective on the housing market, remind you for the updated forecast for the entire 2024, and tell you what you can do in order to control your interest rate. Hint, the answer is not much. But first, let's take a breath together. All right. If this is your first time hearing the sound of my voice, my name is David. I have a background as a mortgage underwriter, lender, and realtor. So, yes, that is the entire home buying process. I purchased multiple homes myself, but most importantly, I've helped hundreds of people just like you buy their first home in real life. I don't just talk about it on the internet. Let's go get those keys. Welcome back to House Rich, the first time homebuyer show where we provide you actionable steps in layman terms to buy your first home. Let's get right into these headlines because I've seen them too, right? Mortgage rates stuck above 7% as rates tick up from bank rate. Mortgage rates jump back over 7% as stronger economic data rolls in. So let's look at this from a macro and micro perspective. So first from the micro perspective, interest rates, they go up and they go down, right? So if you're watching on YouTube, you'll see this chart I have above you. Rates were above 7% in July. They went up, they went down to 6.8. They tick up, they tick down, they tick up, they tick down above 7. They shot up in October 2023 to 8%. They climbed back down as the Fed, as we'll get to why this is important, the Fed cut rates. They tick back up, they jump back down, they drop down drastically in December, all the way down to 6.6%. And they've been kind of ticking up and down, and now they're back above 7% because rates do not maneuver like in a flat line. So now let's see what the Mortgage Banker Association has to say about the current state of the interest rates and what's kind of causing it to go up in this case. A strong job market is good news for spring buyer season as higher household incomes are a necessary component. But it also means that mortgage rates are not likely to decline much further at this point. And that's from Michael Frantanoni, chief economist of the Mortgage Bankers Association. And he's talking about a strong job market is good because people need money to buy homes at these elevated prices and rates. But it's also bad news because a stronger job market means that the inflation will not decline at a quicker rate. And we'll get into inflation and the importance of inflation in a second. But I want to remind you of the 2024 forecast in their entirety and where rates may be going over the course of the entire year. Because focusing on rates from day to day and week to week makes no sense. It just stresses you out and it's a recipe of disaster. Because here's the thing, unless you're going under contract in the next week, the rate today does not matter. But let's say you're starting your job search this weekend. Realistically, you're not going to find a home the first day, right? You're probably going to take somewhere between 2 weeks to 2 months to buy a home. So here's the thing. Let's say it takes you 2 months. The rate today obviously is going to be different than the rate in 2 months. And I'll get into why it'll be better in a second. A lot of hooks in this episode, right? But even the rate like 2 weeks from now will be different than it is today. 2 weeks ago, rates were below 7%. And I did say I was going to get to that forecast, so without further ado, here are the 2024 forecasts from various organizations that do a lot more research on the topic than you do and I do. So let's see what they have to say. The Mortgage Bankers Association has rates going to be about 6.1% by the end of 2024. Fannie Mae has them at 5.8%. Realtor.com, 6.5%. Redfin, 6.6%. And Wells Fargo, 6.45%. So rates are in the sevens, but it looks like most people think that rates will at least drop 0.5%, and in some scenarios, a whole percent by the end of 2024. Now, why in the world is it going to take to 2024 in order for these rates to drop? Let's check in with Matthew Graham, the chief economist for Mortgage Daily News, and see what he has to say. The future of rates in 2024 is all about ifs and thens. If we see more data like last Friday's job reports, rates will have a hard time getting back below 7%. But inflation is even more important than the jobs market. If inflation comes in cooler than expected, it could balance the outlook. And that is because external factors play a much bigger role on your interest rate than anything you or I can control. Here are the things that you can control when it comes to your interest rate. The better your credit score, the better your interest rate, despite nonsense you may have seen in the middle of the year by Biden punishing home buyers with a better credit score. Your term, the shorter the term, the better the rate. The loan amount, the bigger the loan amount, the better the rate. The down payment, the higher the down payment, the better the rate. The property type, a single family home is going to have a better rate than like a condo or a multifamily home, and as well as the type or the use of the property. So like a primary residence bigger has a better interest rate than a vacation home or an investment property. Now, here are the external factors that play the biggest role when it comes to your interest rate. They are inflation, economic growth, Federal Reserve policy, the bond market, and the housing market. Now, I'm going to bundle inflation, rate of economic growth, and the Fed's monetary policy together because they're all interconnected. So, as a reminder, the Federal Reserve's mandate from Congress is to get inflation below 2%. Now, how do they do that? They essentially control the cost for other banks to borrow money. So when it's harder for banks to borrow money or more expensive for banks to borrow money, they pass the savings or the non-savings along to you, the consumer, and businesses. I'm a realtor in Dallas and would love to help you reach your goals of home ownership. So click the link in the description and just schedule a call no matter where you are on your journey. Not in Dallas? No worries, I can help connect you with a vetted realtor in your local jurisdiction as well. And feel free to share with friends, family, and foes. Everyone gets love. When things are more expensive, people kind of hesitate on spending. Remember during COVID where money was essentially free? The reason was because the Federal Reserve lowered the cost to borrow money to almost 0%. Normally or prior to COVID, it was between like 2 and 3%. The cost to borrow money, not your interest rate. But they lowered it to about 0.25% during COVID in order to stimulate the economy. As a result, the banks and lenders lowered rates and therefore people borrowed more money. And that is one of the reasons home prices skyrocketed, because when the cost to borrow money was between 2 and 3%, the average interest rate for you and me was somewhere between 4 and 5%. But when it dropped to the high 2s to low 3s, now people that could only air quotes afford like a $300,000 home could now afford a $400,000 and $500,000 home. Therefore, there were more people that had demand for homes and home prices increased. Right now, the cost to borrow money is between like 5.25 and 5% as the Fed is battling inflation. Remember back in basically all 2023, when the Fed kept raising and raising and raising the cost to borrow money, that raised the cost of interest rates, and inflation did take a dive, but still we're at about 3.5 to 3.8% of inflation. So there is still a ways to go, but it's going in the right direction. But interest rates will not drop significantly until the Federal Reserve cuts rates. They'll just maneuver back and forth between below 7% and above 7%. So the Federal Reserve actually makes a drastic change to cut rates. In 2024, it's anticipated that rate cuts will not start until possibly about May. But once again, no one really knows, not even the Federal Reserve at this point, because they look at the data to determine what they're going to do during their meetings. But the anticipation is they may cut rates about 4 to 6 times in 2024. And here's a quote from the good folks at Morningstar. Since July 2023, the Federal Reserve has kept the federal funds rate at a target range of 5.25 to 5%, far above typical levels the past decade. But we expect the Fed to begin cutting rates in March 2024. They're saying March. What I've seen is April, May, but I guess we will see, bringing the federal funds rate to 3.75% to 4% at the end of 2024. This is one of the more aggressive predictions I've seen from the prognosticators. That's a hard word to say. Lastly, let's talk about the bond market and the 10-year treasury yield, because while the benchmark rate influences the cost of borrowed money and it impacts mortgage rates, what essentially has a direct impact on mortgage rates is the 10-year treasury yield. And I'm going to read you exactly what it is from NerdWallet. The 10-year treasury yield describes what a 10-year US treasury note will pay over 10 years if bought today. Known as T notes, treasury notes are a low risk, fixed income investment that pays a set rate of interest every 6 months. As one of the lowest risk investments on the market, the 10-year treasury yield and its yields are important for several reasons. First, the 10-year treasury yield is a baseline against which the risk of other investments is assessed. Treasury yields also affect interest rates for other types of consumer debts like real estate and mortgage loans. Finally, supply and demand for treasury yields fluctuate with the economic climate. When markets or world events turn, investors tend to flock to treasuries in search of a safe haven. When times are good, though, investors tend to seek out other investments that can provide a more favorable return. Translation: it's essentially an economic barometer because when things are going bad, folks go to that safe haven, the 10-year treasury yield. It doesn't have the best returns, but it's guaranteed and it's safe. And when things are going good, the good times are rolling, they take more risk and invest in other things such as mortgage backed securities where they can get a higher return for their investment. So if you ever look at a chart comparing the 10-year yield to the 30-year mortgage rate, they mirror each other exactly. When the 10-year yield goes up, mortgage rates go up. When it drops, mortgage rates drop by essentially the exact same percentage. And unfortunately, you as a consumer have zero impact on what that 10-year treasury yield is going to do. So you can just focus on things you can control, your budget. Are you mentally and financially stable to buy a home, and then move forward from there? But as always, buy land. Rumor has it they're not making any more of it.